Hello students, welcome to the lecture on export finance. And after this lecture, we will be able to learn the following objectives. Describe institutional support for export finance. Discuss on the Reserve Bank of India. Understand commercial banks. Discuss on Export-Import Bank of India. Explain turnover policy. Let's start with the concept of export finance. Credit and finance is the life and blood of any business, whether domestic or international. It is more important in the case of export transactions due to the prevalence of novel non-price competitive techniques encountered by exporters in various nations to enlarge their share of world markets. The selling techniques are no longer confined to mere quality, price or delivery schedules of the products, but are extended to payment terms offered by exporters. Liberal payment terms usually score over the competitors not only of capital equipment but also of consumer goods. The payment terms, however, depend upon the availability of finance to exporters in relation to its quantum, cost and period at pre-shipment and post-shipment stage. Production and manufacturing for substantial supplies for exporters take time in case finance is not available to exporter for production. They will not be in a position to book large export order if they do not have sufficient financial funds. Even merchandise exporters require finance for obtaining products from their suppliers. Financial assistance is extended by the banks to the exporters at pre-shipment and post-shipment stages. Financial assistance extended to the exporter prior to shipment of goods from India falls within the scope of pre-shipment finance, while that extended after shipment of the goods fall under post-shipment finance. While the pre-shipment finance is provided for working capital for the purchase of raw material, processing, packaging, transportation, warehousing of the goods meant for export, post-shipment finance is generally provided in order to bridge the gap between shipment of goods and the realization of proceeds.
Every small business needs a steady flow of cash to run smoothly, especially when exporting goods. Exporting creates new growth opportunities and new challenges. It's a big hassle to chase invoices across borders. Language barriers and red tape mean your cash gap grows. And domestic banks usually won't fund international receivables. But there's another way to improve your cash flow, and it's called factoring, or accounts receivable financing. Here's how it works. You make a sale and generate an invoice to your customer with specific payment terms. You send the invoice to Bibby International Trade Finance. We buy that invoice from you and immediately pay you up to 85% of its total value. We handle the collection process, accepting multiple currencies and reaching your customers in their own language from one of our many worldwide offices. Once the customer pays us in full, we pay you the remaining 15% minus our fees. And to give you more flexibility, you can pair factoring with our purchase order financing service. Because it's based on your outstanding invoices, we don't discriminate against seasonal businesses or startups or companies that have hit hard times. Think of us as your international trade finance experts.
Let us now discuss the institutional support for export finance. Export finance refers to financial assistance extended by banks and other financial institutions to businesses for the shipping of products outside a country or region. Export financing enables MSMEs to expand its reach to a global audience. An exporter should first gain understanding of some documents commonly required by export finance institutions. These documents are mandatory requirements for most types of export finance assistance. Export finance assistance is extended at various stages of exports. Loans or advances are granted by financial institutions to exporters for financing the purchase, processing, manufacturing or packaging of goods prior to shipment, which is known as pre-shipment credit. Export promotion in India. It is prone for a multi-dimensional approach by its central government in several productive sectors. export credit is considered a priority for commercial bank credit. Illustrates that export credit is just about 5% of the total commercial bank credit, and its high degree of volatility is a matter of concern. So it is important that the country spends more sustained efforts in the field of export promotion. It is facilitated through two apex institutions, namely the Export Credit and Guarantees Corporation (ECGC) and the Export-Import Bank of India. The main role of ECGC is to provide credit risk insurance, overseas investment insurance, and offer guarantees to commercial banks in order to support their credit facilities to exporter clients. It offers various products for exporters, including factoring, overseas investment guarantee, exchange fluctuations risk cover, buyer's policy, post-shipment export credit guarantee, construction workers policy, buyer exposure policies, transfer guarantee, export performance guarantee, export finance guarantee, insurance covers for buyer's credit and line of credit, standard policy, export turnover policy, small exporters policy, packing credit guarantee, and export finance guarantee. Its engineering sector was able to diversify the narrow export base through the Engineering Export Promotion Council (EEPC) set up in 1955. Methodology. We study the viability of the two institutions, ECGC and the EXIM Bank of India, from 1995 to 2010 through their financials. The objective was to determine whether these institutions were successful in export promotion. Since India joined the World Trade Organization (WTO) in 1995, the country has to abide by the regulations and provisions. This study is based on the data from 1995 to 2010. The ECGC collects premiums from its insurance services and honors claims when and where invoked. It continues to make an attempt for recovering the non-payment part from the defaulting businesses. The EXIM Bank offers loans and guarantees, and the operational success is dependent upon its available resources such as deposits and loans besides capital. Now moving on to the next topic, we will talk about the Reserve Bank of India. The central bank of the country is the Reserve Bank of India. It was established in April 1935 with a share capital of INR 5 crores on the basis of the recommendations of the Hilton Young Commission. The share capital was divided into shares of INR 100 each fully paid, which was entirely owned by private shareholders in the beginning. The government held shares of nominal value of INR 2,20,000. Reserve Bank of India was nationalized in the year 1949. The general superintendence and direction of the bank is entrusted to Central Board of Directors of 20 members, the governor and 4 deputy governors, 1 government official from the Ministry of Finance, 10 nominated directors by the government to give representation to important elements in the economic life of the country, and 4 nominated directors by the central government to represent the 4 local boards with the headquarters at Mumbai, Kolkata, Chennai and New Delhi. Local boards consist of 5 members, each central government appointed for a term of 4 years to represent territorial and economic interests and the interests of cooperative and indigenous banks.
75 years ago, we were given the responsibility to operate the country's currency and credit system to its advantage. We strive to promote inclusive growth and ensure that credit is always available for productive purposes. We aim to maintain stable prices over time and help maintain a stable financial system and ensure the safety of your deposits. We aspire to see that every household has access to all financial services and not just a bank account. We ensure that foreign exchange is available for business and personal purposes. We ensure genuine notes and efficient payment systems to facilitate your daily monetary transactions. We work towards making your children financially responsible citizens.
You may not be dealing directly with the Reserve Bank, but what we do touches your life every day.
Functions of Reserve Bank of India. The Reserve Bank of India Act of 1934 entrusts all the important functions of a central bank, which are Bank of Issue under Section 22 of the Reserve Bank of India Act. The bank has the sole right to issue banknotes of all denominations. The distribution of 1 rupee notes and coins and small coins all over the country is undertaken by the Reserve Bank as agent of the government. The Reserve Bank has a separate issue department which is entrusted with the issue of currency notes. Banker to government. The second important function of the Reserve Bank of India is to act as government banker, agent and advisor. The Reserve Bank is agent of central government and of all state governments in India, excepting that of Jammu and Kashmir. Bankers, bank and lender of the last resort. The Reserve Bank of India acts as the banker's bank. According to provisions of the Banking Companies Act of 1949, every scheduled bank was required to maintain with the Reserve Bank a cash balance equivalent to 5% of its demand liabilities and 2% of its time liabilities in India. By an amendment of 1962, the distinction between demand and time liabilities was abolished and banks have been asked to keep cash reserves equal to 3% of their aggregate deposit liabilities. The minimum cash requirements can be changed by the Reserve Bank of India. Controller of credit. The Reserve Bank of India is the controller of credit, that is, it has the power to influence the volume of credit created by banks in India. It can do so through changing the bank rate or through open market operations. According to the Banking Regulation Act 1949, the Reserve Bank of India can ask any particular bank or the whole banking system not to lend to particular groups or persons on the basis of certain types of securities. Since 1956, selective controls of credit are increasing being used by the Reserve Bank. Custodian of foreign reserves. The Reserve Bank of India has the responsibility to maintain the official rate of exchange. According to the Reserve Bank of India Act 1934, the bank was required to buy and sell at fixed rates any amount of sterling in lots of not less than INR 10,000. Since 1935, the bank was able to maintain the fixed exchange rate, though there were periods of extreme pressure in favor of or against the rupee. After India became a member of the International Monetary Fund in 1946, the Reserve Bank has the responsibility of maintaining fixed exchange rates with all other member countries of the International Monetary Fund (IMF). Supervisory functions. In addition to its traditional central banking functions, the Reserve Bank has certain non-monetary functions of the nature of supervision of banks and promotion of sound banking in India. The Reserve Bank Act 1934 and the Banking Regulation Act 1949 have given the RBI wide powers of supervision and control over commercial and cooperative banks relating to licensing and establishments, branch expansion, liquidity of their assets, management and methods of working, amalgamation, reconstruction and liquidation. Promotional functions. With economic growth assuming a new urgency since independence, the range of the Reserve Bank's functions has steadily widened. The bank now performs a variety of developmental and promotional functions which at one time were regarded as outside the normal scope of central banking. The Reserve Bank was asked to promote banking habit, extend banking facilities to rural and semi-urban areas, and establish and promote new specialized financing agencies. Classification of RBI's functions. The monetary functions, also known as the central banking functions of the RBI, are related to control and regulation of money and credit, that is, issue of currency, control of bank credit, control of foreign exchange operations, banker to the government and to the money market. Monetary functions of the RBI are significant as they control and regulate the volume of money and credit in the country. Let's know the meaning of commercial banks. The commercial banking industry in India started in 1786 with the establishment of the Bank of Bengal in Calcutta. The Indian government at the time established three presidency banks. The Bank of Bengal, established in 1809, the Bank of Bombay, established in 1840, and the Bank of Madras, established in 1843. In 1921, the three presidency banks were amalgamated to form the Imperial Bank of India, which took up the role of a commercial bank, a banker's bank, and a banker to the government. The Imperial Bank of India was established with mainly European shareholders. It was only with the establishment of RBI as the central bank of the country in 1935 that the quasi-central banking role of the Imperial Bank of India came to an end. In 1860, the concept of limited liability was introduced in Indian banking, resulting in the establishment of joint stock banks. In 1865, the Allahabad Bank was established with purely Indian shareholders. Punjab National Bank came into being in 1895. Between 1906 and 1913, other banks like Bank of India, Central Bank of India, Bank of Baroda, Canara Bank, Indian Bank, and Bank of Mysore were set up. Functions of commercial banks. The main functions of a commercial bank can be segregated into three main areas. Payment system. The main functions of a commercial bank can be segregated into three main areas. Payment systems, financial intermediation, financial services. Payment system. Banks are at the core of payment systems in an economy. A payment refers to the means by which financial transactions are settled. A fundamental method by which banks help in settling the financial transactions process is by issuing and paying checks issued on behalf of customers. Further, in modern banking, the payment system also involves electronic banking, wire transfers, settlement of credit cards, transactions, etc. In all such transactions, banks play a critical role. Financial intermediation. The second principal function of a bank is to take different types of deposits from customers and then lend these funds to borrowers. In other words, financial intermediation. In financial terms, bank deposits represent the bank's liabilities, while loans disbursed and investments made by banks are their assets. Bank deposits serve the useful purpose of addressing the needs of depositors who want to ensure liquidity, safety as well as returns in the form of interest. On the other hand, bank loans and investments made by banks play an important function in channeling funds into profitable as well as socially productive uses. Financial services. In addition to acting as financial intermediaries, banks today are increasingly involved with offering customers a wide variety of financial services including investment banking, insurance-related services, government-related business, foreign exchange businesses, wealth management services, etc. Income from providing such services improves a banker profitability. Exim Bank extends lines of credit (LOCs) to overseas financial institutions, regional development banks, sovereign governments and other entities overseas to enable buyers in those countries to import goods and services from India on deferred credit terms. The Indian exporters can obtain payment of eligible value from Exim Bank without recourse to them against negotiation of shipping documents. How does it work? Exim Bank signs LOC agreement with overseas borrower institution and announces the availability of LOC for utilization when the agreement becomes effective. Exporter checks with Exim Bank available amount under the LOC and quantum of service fee payable to Exim Bank if any and negotiates contract with importer. Importer approaches the borrower for approval of the contract. Borrower appraises the proposal. If satisfied, approves the contract and refers to Exim Bank for concurrence for inclusion of contract for being financed under the LOC. Exim Bank accords approval to contract if any conformity with the terms of LOC. Exim Bank conveys contract approval to the exporter and the borrower. The importer arranges a remittance of advance payment to the exporter and also opening of a letter of credit which states that the contract is covered under Exim Bank's LOC to the borrower and reimbursement will be by Exim Bank for the eligible value of credit upon compliance with stipulated conditions therein. Exporter executes the contract, ships the goods, provides services. Exim Bank, commercial bank in India designated as negotiating bank, negotiates shipping documents and pays the exporter. Exim Bank reimburses the negotiating bank on receipt of valid claim and service fee as applicable by debit to the LOC account of the borrower. Borrower repays Exim Bank on due dates. Eligible goods, capital goods, plant and machinery, industrial manufactures, consumer durables and any other items eligible for being exported under the Exim policy of the Government of India. General exporters are advised to check with Exim Bank before finalizing the contracts with the buyers. Details of service fee and other charges, if any, payable by the exporters on the contracts to be covered under the relative LOC. For terms and particulars of specific LOCs, please refer to relevant brochures available with Exim Bank's offices in India. Indian exporters requiring additional information or clarifications are to visit Exim Bank's website, which contains detailed information on bank's LOCs with a multilingual option, Spanish, French, Russian and Portuguese besides English. To contract any of Exim Bank's offices in India overseas. Benefits of LOC to the Indian exporter under Exim Bank's LOCs. The Indian exporters can obtain payment of eligible value from Exim Bank without recourse to them against negotiation of shipping documents. The Indian exporter does not carry any credit risk either on the importer or the importer's country, whilst the overseas importer enjoys deferred credit facility. Thus, LOC is a safe mode of non-recourse financing option to the Indian exporter and serves a market entry tool for India's exports. The Indian exporter can also increase his export volumes by offering deferred credit where required. Credit period allowed. Under the LOC, generally, export of capital goods and plant and machinery is allowed on credit terms of up to 5 years, whereas the export of industrial manufactures, consumer durables, raw materials and commodities is allowed on credit terms of up to 2 years. However, the credit period allowed under each LOC could be different. There are certain short-term LOCs which provide for credit period of 1 year, and there are certain LOCs which permit credit period beyond 5 years. Exporters are advised to check the details with Exim Bank in advance. In respect of LOCs extended by Exim Bank, at the behest of Government of India, credit period ranges from 8 years to 20 years depending on the categories of countries based on their levels of incomes and external debts. Pre-shipment export credit. Pre-shipment means any loan or advance granted or any other credit provided by a bank to an exporter for financing the purchase, processing, manufacturing or packing of goods prior to shipment on the basis of letter of credit opened in his favor or in favor of some other person by an overseas buyer, or a confirmed and irrevocable order for the export of goods from India or any other evidence of an order for export from India having been placed on the exporter or some other person, unless a lodgement of export orders or letter of credit with a bank has been waived. Post-shipment export credit. Post-shipment credit means any loan or advance granted or any other credit provided by an institution to an exporter of goods from India from the date of extending credit after shipment of goods to the date of realization of export proceeds. Rediscounting of export bills abroad scheme EBR. General. Banks are also allowed to rediscount export bills abroad at rates linked to international interest rates at post-shipment stage. Exporter's choice. The exporters have the option to avail of pre-shipment credit and post-shipment credit either in rupee or in foreign currency. However, if the pre-shipment credit has been availed in foreign currency, the post-shipment credit has necessarily to be under the EBR scheme, since foreign currency pre-shipment credit has to be liquidated in foreign currency. Turnover policy is a variation of the standard policy for the benefit of large exporters who contribute not less than INR 10 lakhs per annum towards premium. Therefore, all the exporters who will pay a premium of INR 10 lakhs in a year are entitled to avail of it. Distinct features of turnover policy. The turnover policy envisages projection of the export turnover of the exporter for a year and the initial determination of the premium payable on that basis, subject to adjustment at the end of the year based on actual. Foreign Exchange Dealers Association of India FEDAI. Foreign Exchange Dealers Association of India was set up in 1958 as an association of banks dealing in foreign exchange in India, typically called authorized dealers. Authorized dealers as a self-regulatory body and is incorporated under Section 25 of the Companies Act 1956. Its major activities include framing of rules governing the conduct of interbank foreign exchange business among banks vis-a-vis public and liaison with RBI for reforms and development of forex market. Now in the end, let us summarize what we have learned in this lecture. India is prone for a multi-dimensional approach by its central government in several productive sectors. The ECGC collects premiums for its insurance services and honors claims when and where invoked. The distribution of 1 rupee notes and coins and small coins all over the country is undertaken by the Reserve Bank as agent of the government. To better align the banking system to the needs of planning and economic policy, it was considered necessary to have social control over banks. Mutual funds offer competition to banks in the area of fund mobilization in that they offer alternate routes of investment to households.